Welcome back. Now on to our special segment, Fin Street. Abhishek is standing by the big wall with all of the details on the FY23 business momentum for the banking sector. Abhishek, take it away.
Well, incremental business momentum for the banking sector in FY23 has been the best ever, with incremental deposit momentum of 15.8 lakh crore and incremental loan growth of about 17.8 lakh crore. Hence, the incremental credit deposit ratio or the CD ratio for the banking sector was at 113%, which is the highest in last 15 years. In a rising interest rate scenario, an increase in CD ratio augurs well for lenders, given the fact that it will help the net interest margin remain on the healthier side or not fall sharply. However, one can expect the net interest margin of lenders to decline from Q1 FY24 results onwards. This will be due to the fact that the rise in cost of funds for lenders will start kicking in as maximum hike on the lending side is already done or has taken place. Banking sector has ended FY23 with total deposits of 180.44 lakh crore and total loans of about 136.75 lakh crore. The credit deposit ratio for the sector for FY23 is the best in last 3 years, coming in at 75.8% when compared to 72.2% in the previous year. Now, deposit data shows that on an incremental basis, the growth in demand deposit is the lowest or slowest in last 3 years, while the incremental term deposit growth in a fiscal is perhaps the best ever that you have seen. Also, kindly note that some of the low-cost deposits may have moved to high-cost term deposit due to rise in interest rates that we saw in FY23. Now, sectoral data as of Feb 2023 shows that personal loan has been the big driver of loan growth in FY23. So as of Feb 2023, incremental loan growth has been about 15.6 lakh crore. A breakup shows that incremental loan growth has been driven by personal loans, which formed about 40.2% of the incremental loan growth. Services formed about 32.5%. Agriculture about 12.5%. Industry close to 9%. While food credit actually saw a decline nearly by 19,700 crores or about 1.3% year to date in Feb 2023 so far. Now, the loan breakup for the industry as of Feb 23 shows that personal loans formed about 29.8% of the loans, services formed about 26.2%, agriculture nearly about 24.5%, industry about 12.3%, food credit nearly 7%, and others about 0.26%. So in terms of outlook, the loan growth may slow down going ahead. Higher repayments of principal amount in the EMI can also lead to slowdown in the loan growth rate. Inflation, that can also hurt the loan growth for the banking sector in coming quarters. However, the key to watch will be the deposit momentum. The war has already started on deposit rates, especially by HDFC Bank, which is offering one of the highest term deposit rates amongst large peers. Now, private banks have gone back to branch expansion in order to grow their balance sheet. PSU banks, many have seen their balance sheet grow due to the foreign book as well. So with slowdown in global economy, we will need to watch out for the performance of overseas book for some of these PSU banks.
Abhishek, busy day for you. Thank you very much for joining in with